I'll give you a very simple tip. If the market's making higher highs on the day chart or the 4-hour chart, then we're in an uptrend and you should be buying dips. If the market's making lower highs and lower lows on the day or 4-hour chart, the market's in a downtrend and you should be selling rallies just using simple indicators like moving averages, Bollinger Bands, stochastics, RSI, MACD. All of the usual things that you'll read about will probably not make you a profitable trader. There are many more factors and variables to consider when you're trading. What are the most effective strategies for beginner traders? Now, there are countless strategies out there and countless people trying to sell you strategies that they claim to work. And many of them rely on indicators like moving averages and oscillators, stochastics, Bollinger Bands, MACDs. And then there's the whole host of other people that advocate price action only and no indicators on the charts. There are some that advocate trend lines only, some that advocate channels only, and candlesticks, for example, price action, Wyckoff distributions, and you can go on and on and on. There are many, many, many ways to trade the markets. And first of all, you have to decide whether you want to be a day trader. In other words, you're in the market for just a short period of time, every day, normally at a fixed time, trying to get in and out of your trades as quickly as possible, and then closing down all your trades by the end of the day. A swing trader, on the other hand, will be looking to get the larger swings across a variety of instruments. That's what I do, and look for maybe not as precise entry points as you may do when you're day trading, but looking for regions and zones to trade from, and then to swing those as the markets move up and down. If you're simply an investor, like I mentioned earlier, and you want to be just dollar cost averaging, buying dips, entering and exiting various tech stocks or other stocks, commodity stocks, whatever, then you'll have a whole different approach. There are all sorts of ways to trade the markets, but I can tell you one thing, just using simple indicators like moving averages, Bollinger Bands, stochastics, RSI, MACD, all of the usual things that you'll read about will probably not make you a profitable trader. There are many more factors and variables to consider when you're trading, including economic news, market direction, sentiment, sector rotation, support and resistance lines, supply and demand, dark pools, and it goes on and on and on. There's also, of course, the fundamental approach to trading where people say, well, you don't really need the charts. You just need to know what's going on in the sphere of world or domestic economics. And all you need to know is what the interest rates are likely to do, or what the GDP is, or what the jobs report is, or what inflation's likely to do next month in order to nail your next trade. Now, of course, the real answer is in a combination of all those things, strategically using indicators, as few as possible in my opinion, also using chart patterns and candlesticks, support and resistance lines and horizontal lines, channel lines. And then, of course, one needs to know broadly what's going on in the economical world, in the fundamental economics of the whole market. So it's a combination of various things. But if you're starting out in trading, I would suggest a couple of things that you can do at the outset. One is to get a firm grasp of candlestick trading patterns. I highly recommend getting the Steve Nisson books, that's Nison, on candlestick trading. And then also to get a basic understanding of technical charting indicators, the ones that I mentioned earlier, like stochastics, RSI, MACD, moving averages, etc. And then it's a good idea to familiarize yourself with economic factors, numbers, reports that come out every week that might and will move the market on many occasions. Once you've mastered the fundamentals, and that takes some study and some effort from you, so you're going to have to put some homework in all three of those areas, then you need to come up with a trading system or strategy that you know that you can apply consistently, repeatedly, do it the same every time, use the same ideas, the same thoughts, the same analyses every time you approach the market. And you might be wanting to apply different trading systems to different markets that you might be in. For example, I trade stocks, I trade commodities, I trade futures, I trade metals, I trade currencies. In fact, anything that can be traded, basically, I trade. So sometimes those different markets will have different approaches required, and you'll have to know what the difference between the markets are. Now, there are loads of trading systems that one can use. Some of them can be fully automated, like robotic, algorithmic trading systems, where something crosses something, then you do this. If something goes the other way, then you do that. Or if the 5-minute RSI does this on that chart, on this commodity, whatever it might be, then you do this or do that. Mechanical trading systems sometimes work, most of the time not. And as the market changes, because they're fixed algorithms, in other words, they work in a certain way in certain market conditions, they may fail in the future. Also, they're not known to generate very large profits. So if you can beat the indices, for example, on the S&P or the NASDAQ, just using an algorithm or a bit of code, you're doing pretty well. That's pretty unusual. The best way I would say, and this is the way I trade, is by just simply drawing in a few trend lines, some horizontal lines, looking for the trend direction and trading in the direction of that trend. So if the trend's up, as determined by, for example, the day chart or the 4-hour chart, one wants to be buying on the dips. If the trend's down, one wants to be selling on the rallies. I'll give you a very simple tip. If the market's making higher highs on the day chart or the 4-hour chart, then we're in an uptrend and you should be buying dips. If the market's making lower highs and lower lows on the day or 4-hour chart, the market's in a downtrend and you should be selling rallies and looking for areas to sell into. The areas that you buy and sell into could be determined simply by horizontal lines, support and resistance lines, order blocks, or even just simple trend lines or moving averages. I use the 20, 50, 100, and 200 period simple moving averages on all of my charts, and I use those simply as support and resistance lines. If that's all you do, look for the trend direction, higher highs and higher lows, or lower highs and lower lows, and use those support levels provided by the moving averages or horizontal lines or trend lines, channel lines, then you should do pretty well. It really is as simple as that in its essence. Of course, when you're trading in the cut and thrust of things, it's not as easy as that. It doesn't seem to be quite as simple.